In this video from accounting101.org, we're going to talk about the basis of shareholder and corporate level transactions, specifically 351 transactions. So the basis at the shareholder level, as a general rule, it's on a substituted basis. So when the shareholder transfers assets to the corporation, whatever basis the shareholder had in those assets is the basis that they're going to have in the stock. So that means it's a substituted basis. And a realized gain is not recognized, and the deferred gain is preserved in the lower stock basis. The next thing, when boot or treatment of boot at the shareholder level, if boot is issued, the gain will be recognized to the lesser of fair market value or the boot itself. Or the boot itself or the realized gain. Property that is treated as boot will have a basis of fair market value in the hands of the shareholder. The deferred gain on the property that has been transferred into the corporation will be preserved, but it will also be reduced by the amount of the gain recognized as a result of the boot distribution. Okay, now the basis at the corporate level. Again, as a general rule, this will have carryover basis, which is driven by Section 362, which says that assets that are transferred into the corporation have the same basis that they had in the shareholder's hands. Now, substituted basis means that the basis the shareholder had on the property will be the basis of the stock that he gets from the corporation, and carryover basis is the basis the assets had in the hands of the shareholder will be the basis of the assets inside the corporation. Now, property transfer to the corporation can result in a second built-in gain, and that is also subject to being taxed when the corporation sells the asset. There's one built-in gain in the stock that the shareholder takes back from the corporation, and a second built-in gain on the asset inside the corporation. The deferred gain is preserved by the lower asset basis, which will be recognized when the asset is sold. Now, when boot is issued at the corporate level, the gain that's recognized will increase the basis of the assets contributed to the corporation. The deferred gain is reduced by the amount of gain recognized as a result of the boot distribution. So going on to built-in loss property. Now, the contribution of an appreciated asset can result in two built-in gains, one at the shareholder level and one at the corporate level. The same thing can happen the other way around. A property with a built-in loss that is contributed to a corporation can result in a second built-in loss at the corporate level. This was abused before 2004, before Section 262E2 was passed, and this section required that the corporation holds the lost property with a basis equal to its fair market value on the date that it's contributed to the corporation, which gets rid of the possibility of the second built-in loss. And what was happening is corporations were sheltering their other gains using these second built-in losses at the corporate level. So the test to determine whether there's a built-in loss is not done on an asset-by-asset basis, but it's done in aggregate of all the assets. So Congress allows potential double built-in gains so that you can pay taxes twice, but it does remove the possibility of double built-in losses. Now, going on to holding period. The holding period is going to determine whether or not the sale of a capital asset will be taxed at short-term rates or long-term rates. Now, as long as the asset transferred in are either capital assets or 1231 assets, then the holding period that the shareholder had into those assets will be tacked onto the stock the shareholder receives. So, for example, if I contributed a capital asset that I had owned for 3 years, the stock I receive once I contribute that asset to the corporation will have a holding period of 3 years tacked on, as if I had owned the stock for 3 years. So what this means is the next day after the contribution, hypothetically, I could sell the stock and it would be taxed at the long-term rate as if I had owned it for 3 years, like I owned the property that I contributed to the corporation. Okay, and that's it for this video. It's another video from accounting101.org. You can go to our site, accounting101.org, for more tutorials or videos like this.